Hello, this is Chris with Life 180 and the Life 180 Roadmap, and now we're going to get into the technicals. We're going to get into where the rubber hits the road. I know I said that at the beginning of the module, and it's absolutely true, but here's what I have to say. It's been really, really important for you to go through all of the videos and educate yourself, because as we go through this, I'm going to show you how to structure, how to go through and find the money, and how to kind of set your financial life up in a way that you can start plugging the leaks and stop losing money unknowingly and unnecessarily, and put yourself in a position so you can better your financial world. And really, it starts with organization and getting your life on paper and getting your finances on paper. So what I wanted to do for this video is walk you through some of the worksheets and walk you through. I have an example sheet that I just put together here, kind of a classic situation of people that I've worked with before, kind of an average of a lot of the clients and people that I've helped in my life, and just walk you through this. So what I want to do is just go through and show you how to fill this out and the key things to think about, what to look for, where to find the money, how to deal with it, all that stuff. So here we go. Let's get into it. I'm gonna change the aspect ratio here a little bit of this form, just so we can focus on a little more here. All right, so here we go. We have Harry and Sally. I was just thinking of the movie When Harry Met Sally, and so I guess that's why I put them in there. They have two kids. You can see Harry born in 1979, Sally born in 1980. So they're in their mid-30s, mid to upper 30s, and Lucy, their oldest child, born in 2010, and Mark is 2.5 years younger, born in towards the end of 2012. And so that's pretty common. I find a couple 2.5 years difference in the kids. It's key to put your address just to have it. Like, I guess it's not imperative that if you're filling this out for yourself, but I have it there. But if you are going to work with one of our cash flow consultants to help you kind of get through this, this is where we can really help you out. And so, bang, that's what you get, your email address, and so on and so forth. So now's where it gets, as we get down into the income component, that's where it gets important to start really having this information down. I just put management for Harry, and Sally was in sales. Harry's salary, I don't have an employer in here because I didn't want to get too creative with names or anything like that. But we have Harry with a base salary of $60,000, 2% increase in living, and then Sally with a $40,000 base salary. She's got a sales job, but she's on a salaried sales job, and if she hits her sales bonuses, she'll get a $1,000 bonus at the end of the year. So nothing massive, but that's that. Now, you want to make sure, the key part here is you want to make sure that you put in the increase of salary. We could put effective tax rate in here. We could say 25%. They don't know their effective tax rate at retirement, so it's okay to leave that. Expected inflation rate, we're just going to put 3% there. And then their approximate credit score, let's just say, I'm going to say 720, because that's kind of a normal good score that people could have. If it gets higher, obviously they get up into the 760 range. They can have some benefits with all that, but that's that. So moving forward, make sure they define benefits. What do they have going on? They don't really have anything except for Social Security. That would be any pension that they might have. If anybody works with a railroad pension or government pension, anything like that. For the case of this scenario, I didn't have it in there. They only had Social Security. But if you do have a government pension or anything like that, please make sure you put it in there. That's going to help you. Put in the cost of living adjustment. That's what COLA is, cost of living adjustment on an annual basis. Social Security usually adjusts by about 2%. Taxable, that's all depending on their personal situation. And we're having them start to take the benefit at 67, ending it at 100. That will obviously go until the day they die, but we just put 100 to have a number in there. If they live past that, good for them. So other future income and assets that they're going to inherit. Once again, it's a lot of people are going to have nothing for this. If you're an entrepreneur and you have a potential sale of a business, that might go in there, or if you're going to inherit money from a parent. I am hitting the wrong buttons here. Here we go. Let me just get back up to where I am. If you're going to inherit money from a parent, well, that's where you know, you would put that in there. So I just put that that they're going to inherit $100,000 from Sally's parents, and we're just going to go from there. And so now we get down into assets, right? We get down into assets, and it's just really important to put all of your information in one place that you can kind of look at it as a snapshot and visit this every 6 months or so. And so you can see assets here is that, you know, we start with real estate and mortgages, and you can see here, I'm going to walk through this really quick. The purchase price on their house was $250,000. Their current market value is $300,000. They put a $10,000 down payment. The loan origination, because they bought it a while ago, but their loan origination was 7/1 of 2011. Their original loan amount was $240,000. Their loan terms, they got a 30-year mortgage at 4.5%. The remaining loan balance is $220,347, and they have a monthly mortgage payment of $1,216. Now, that's great. It's key when you put your mortgage information in there that if you have a mortgage, to have all of this information, you know, make sure you have your statement with you, have all of this information as up to date as possible. The most important parts to this are the current market value estimates, right? It doesn't necessarily matter what you purchased the house for in the grand scheme of things, but the amount that the house is worth, the amount that you currently owe on it, the terms of the original loan, the interest rate that you're paying, and your monthly payment. Those are all key components that you want to make sure that you include, because that's where we're going to help find some money potentially. And I'm going to come back through this a little bit and show you where we're going to find some money for these folks based on the education that I've shown you guys. And if you watch the videos on the insurance, on the mortgages, and on all these things, you're going to start seeing this, and it's going to start to click with you, I think, as we go through this. So qualified retirement accounts, this is just their 401ks. I just put Fidelity and TIAA, maybe other companies. I just wanted to put something in there because you needed to see the different. I just want you to see that a company name, whatever the platform is that you're with for a plan, just put it in there. So this is Sally. Oh, I meant to say this is Harry. My bad. So this is Harry. And Harry is putting $3,600 a year, and he's getting that's 3%, or that's 6%, I should say, of his income. He makes $60,000 a year, so 6% of his income is going into his 401k. That's going in pre-tax, and what the employer is doing is they're matching 50% of it. So if he puts 6 in, they're going to put 3% in. So that's that. He's got an account value of $30,000, and he's getting an annual rate of return of 6%. Now that's being very nice of me, liberal of me to give him that 6%. He probably has received 6% over the last couple of years, but over the long run, to receive 6% in a 401k over a 20 or 30 year period of time, after fees, after everything, is a very kind number. And so 401k, I got her same thing, except for the fact that she's putting in 6% of her income. That's just what they decided to do as a couple. She's getting no match from her employer, though. She's been contributing longer. She's been at her job longer, so she's got $12,000, you know, in her account, like whatever. So she's been there, I don't know, 4 or 5 years, and she's got that $12,000 in her account. Once again, 6%. And they also have a 529 account that they're putting in through their state plan. Every state has a 529 option available, or multiple options, and so they're putting $1,000 a year in for their kids, potentially saving up for college, and they have $5,000 currently saved. That's a joint account for both of them. And then you can see we get down here into mutual funds. They're also doing other things. They're putting money aside because they know their 401k isn't quite going to be enough, and so they're putting $200 a piece away out of their paychecks into their mutual funds. And you can see the account balances. He's got 6, she's got 10. Cost basis, so that's how much anything above that is going to be taxed. Anything above that is what they're going to have to pay their taxes on. And you can see here they also have a 3-year CD at a local bank. They put $10,000 in. They just put the money in, and so with that $10,000 that they put in, they got a 1.67 rate of return on it. 10,000. So we're just coming up on their year anniversary. So they got $10,167. That is a joint account. So that's sitting there. That's money that they just didn't want to risk anything with, and so It's sitting in a CD with a bank that they can at least get access to in the case of an emergency if they need it. The challenge is they didn't want to, going back up to that, they didn't want to have that in their money market account because it earns no money. There's no interest to be earned. So we put it in this CD, or they have it in this CD, just so they can get some sort of rate of return, even though 1.67 is still kind of a pathetic rate of return. So moving forward, now we're going to get into the liabilities. We're going to get into the loans. We're going to look at installment loans. So Harry has a student loan. He's paying $200 a month. He's getting towards the end of it. You know, it financed for a long time. He had a big student bill. His parents didn't help him a lot. That's why they want to help their kids. We'll get into that soon. And he's paying 6.5% on these $200. He's got 48 months left, a balance of $11,000 left to pay. And so, bang, like he's good to go. That's just what he has going on there. They have an SUV loan that they're paying 4% on, and that's $500 a month. They got 36. They originally financed it for 5 years, but they got 3 years left on that. And then they have an auto loan, a regular small sedan type car that they share. Of course, they have the SUV because they got 2 kids. They got to cart them and their friends around. And you can see that they owe about $7,800 on the car that they share. They have a credit card. The credit card, their monthly payment they pay on it is $400. Their new monthly charges are $200. They have an interest rate of 15% and unpaid balance of $5,000. So they got that rolling there. They're trying to pay it down, but they can't seem to get ahead. It just keeps kind of hovering after paying the $400 and after putting $200. Maybe they're putting gas on this card, just charging their gas to the card. They just can't seem to get that balance to go down, and they feel like they're kind of stuck in the hamster wheel trying to pay that down. They also have a home improvement store charge card that they use for remodel of a bathroom or some furniture or something of that nature. They're paying $200 a month on that to pay it down. Unfortunately, they didn't pay it off in time for the free interest rate period, and so they're paying 19.99% after their introductory rate. They got $1,500 left to pay on that, so that should be paid off soon, and that is what it is. And then we got life insurance. They both have term insurance. Harry and Sally, they got a $300,000 house, so they wanted some type of insurance to be able to cover the mortgage if anything happened to them. So they have $600 for Harry, $540 for Sally. The reason for that is life insurance is cheaper for women than it is for men because women tend to live longer. So good for them, and that's that. Now they also have auto insurance and homeowners insurance. You can see all the insurance here. They don't have any cash value life insurance. And as far as their other insurance, they don't have an umbrella policy. Their health insurance is through their employers, and that gets automatically deducted. So we're not going to put that down here. If you're an entrepreneur and you have your own expenses for that, you have your own business, you would definitely want to put that there. They don't have disability insurance, so they're exposed there, and they don't have long-term care insurance. So that is a potential exposure as well as they get older. And because the whole world of long-term care insurance is shifting greatly. So you could see here that their deductibles across the board are $500 and their premiums are where they are. And so what we're going to do is we're going to go through and we're going to take a look at that in a minute, but I'm just trying to give you the summary now. Now, expenses, future expenses, they do want to contribute $100,000 to each one of their children's college fund. And granted, they're not going to hit that period of time for 12 and 14 years, but it's something that they need to contribute for. And they're feeling like they're probably so far behind right now that they're going to have to deal with some loans to be able to contribute the way that they want. So what's the impact that has on it? And then as you go, and so just be thinking about how you fill this out and organizing all of this information and just putting all of this in one place for you as you go through. And now these are all the things. These are the key documents that as you go through this course that you're going to want to gather, that you're going to want to put together and really analyze. And you can see you're going to want your paycheck stubs. You're going to want to make sure you have statements on all your investment accounts, whether it's a 401k or whether it's mutual funds that you have in a separate online account or that you manage on your own or you have with a broker or anything of that nature. You want to make sure you have your bank statements. You want to make sure you have copies of your tax returns. You want to organize that in the most because you look at your taxes, you can really get a feel It'll tell you what your effective tax rates are and all that stuff. You really want to break down your insurance policies. You want to make sure that you have all your insurance policies gathered. You want to make sure you evaluate your insurance policies every 6 months to a year at the most, because if you stick with companies, a lot of times over time you can reduce your premiums, so on and so forth. Not always the case with medical, but with your auto, with your home, if you have a good record and all that stuff, you could get that better. Your disability coverage, you want to make sure if you have it. Most people don't have disability income insurance, but it's one of the most overlooked things that people do. We'll talk about that in the module that we talk about building your financial structure, financial pyramid, and how to structure your life. We'll get into that. But then it gets into any benefits that you have through your company. A lot of people don't really think about all the other benefits that come through your employment, but it's something to think about. Your Social Security statements, you typically have to go online at this point in time. They stopped sending the statements out, so make sure you go online and do that. And then if you don't have a will and a trust set up, especially if you have kids and you have a family, that is something you want to do. You can get it done extremely affordably. And we have partners that we can help connect you with if you need that done in an affordable way with a trustworthy place. We can help you out. And you want to make sure, if you're here, you probably have seen the credit cheat sheet already. You want to make sure you've pulled your credit report and you print your credit report and you go through and you follow. I'm going to tell you right now, circle back and go through the Life 180 credit cheat sheet and do that system. Make sure you go through that. And here's what I want to do is I want to go through this now in detail. Now that we've gone through everything, and I want to I'm going to coach you a little bit as to where to find the money, right? And where things are going to be accessible to you, right? Because first of all, actually, before we get to that point, what I want to do is I want to go through what are their liabilities? Where are the big problems here? Where are they? Well, first of all, they've got a lot of problems. Like what's their debt look like? He's got $11,000 in 6.5% interest rate debt, but that 6.5% is partially deductible because student loan interest is partially deductible. So that all depends on his interest rate or his tax rate and all that stuff. But the bottom line is that you look at these two auto loans. Those are 4%. Those are not deductible unless he owns them through a business, which they don't. They're 4%. He's paying 4% there, and he's got $27,800 in auto loans. Is what these two, what this family has, Harry and Sally have. Now, credit cards. This is the part that's crushing them. They're paying $400 a month. That's $400 a month out of their cash flow, and that cash flow is huge. They feel like because of that, it's really impacting their ability to feel like they can keep contributing to their mutual funds that you saw above, and their 401k and all that stuff. So because they're really tight every single month after their expenses. Now, I'm going to tell you right now, we're not going to get into it in this module, but in the next module, we're going to talk about building a budget. We're going to talk about looking at how to organize all your financial world, not just from your assets and liabilities and debts and protections and all that stuff, but from your monthly household expenses, everything from entertainment, to utilities, to everything. It's going to take this and kind of expand upon the idea, and it will show you how to go there. And so that's in the next module. But for this, I can tell you right now, we can find, just looking at this, and this is a pretty normal situation for most people. Most people are not able to save enough money, but I could tell you, I could find this family a lot of money every year, because here's the thing. They're spending $611 plus $540. That's $1,140 for life insurance. Now, what I could tell you is that they probably bought the life insurance through a big company. They're paying a premium just to be with those big companies. There are other companies that focus on cheap term if you want it. So if we're looking just from a cash flow perspective, and we're not talking about cash value insurance, we're just looking at cheap term right now, there's a couple things you want to look at for term insurance that you want to think about. A, is that term insurance convertible? Meaning, can you transition that term insurance to cash value insurance if you need to at any point in time? Most companies don't allow that to happen, but you want to make sure you're with a company that does allow you to convert that insurance. And I can tell you right now, for $300,000 of insurance, we could drop his premium to probably $350 if he's in his mid 30s. Maybe a little less depending on his health rating, but for a standard health rating, somebody who's fairly healthy, takes care of themselves, we're going to say $350 for him, and we could find about $300 for her. So right there alone, we found $250 a year cash flow for him and $140 a year in cash flow for her. So just in their life insurance, we were able to find $390 in cash flow. I'm going to write that down here. $390 in cash flow that we're going to be able to find them just in their life insurance, right? Now, when it comes to auto, I'm going to say these are with the Lizard Auto Group, right? And they're paying premiums with this Lizard Auto Group that are pretty high. Granted, they have a nice SUV and they have a decent car, but if we could save them 25% on these premiums, which is not out of the realm of realistic expectation, because these premiums are pretty high. If we could get their coverage on their SUV down to 900 for the same coverage, and we could get their let's say for the second car down to 700, that's $500 a year just there. And if we could reduce their homeowners insurance to 500, that's now $900 a year in found money, right? Just in their insurances. So now between the two, we've found $1,290 of money that they're losing unknowingly and or unnecessarily. We could take that $1,290 and we can help accelerate paying that money down. The key is finding this money first, right? It is making sure that we go through this process. So now what we're going to do is we're going to say, okay, let's go back up here, and now that we've seen the debt here, let's go back up towards the top and let's look at their assets. Let's look at, they have their mortgage here, which is a 30-year mortgage rate, 30-year mortgage, I should say, at a 4.5% rate. We're going to circle back to that. That gives them a $1,216 mortgage per month. And what are we going to do here? We're going to say, all right, first and foremost, what do we have? I'm going to tell you right now, we're looking at this 3-year CD. That's going to be what sticks out to me. If they have any money there, they might have savings accounts too, right? Savings account, and that savings account could be with a bank, and that savings account might have, let's say it has $4,000 in it, right? $4,000 in it, and that was contribution, but you get my point. $4,000 in it. We'll get there, I promise. So it has $4,000 in it, and the bottom line is this is a joint account. Well, and what's this earning on them? It's earning 0.1%, right? And so they're earning 0.1% in this account, and yet they got that $4,000. Why are they letting that money? They have that there because they're concerned. They think they need it for in case of an emergency. Well, the reality is that I can tell you right now, if you go back down and you look at their credit card debt, if you have a line of credit on your credit card, that is the equivalent of having access to a rainy day account. You want to make sure you use it responsibly. You don't want to abuse it, but you need to make sure that you're not spending unnecessary interest on that. And so what are they doing? When they have money in a savings account, when they have money in a CD earning 1.67%, when they have money in these retirement accounts earning 6%, it doesn't make sense to have any money going towards that credit card, right, at all. So here's what I'm going to say is, let's take the $4,000 out of their savings account, and let's take $1,000 out of their CD that's operating inefficiently, right? So let's do that, and so it'll reduce their account values there. I'm not going to hit the numbers in, but you get my point, and that'll eliminate this $5,000. What will it do? It'll say, okay, they're going to put $200 a month on for their gas because it's convenient. So what can we do? We could say, okay, that's cool. Just pay it off every month. Bang. So $200 is what we're going to drop their payment down, because now they're going to be paying their card in full. Well, not only that, we have this $1,500 payment that we're going to drop and we're going to take that out of their CD and we're going to eliminate $200. We're going to say that's going to go to zero, right? And so now all of a sudden we went from, we just found $400 a month in extra cash flow that we were able to save them and find them that they can save more for building their financial foundation, for building. Remember, I'm not saying you want to invest that money. I'm saying you want to save that money because you don't want to take risk with it. People need to understand the difference between saving and investing. We're going to get into that in the next module as we teach people how to build their financial structure. But the key point is regaining control of your financial life. So here's what we would do. All of a sudden, bang, you have zero money in a savings account, right? All of a sudden, bang, this account value goes down to 9,000, right? And that's what you have. It'll be reset to 9,000. And so now you're okay, but you have all this debt. And so what are you going to be doing? You're going to be contributing. Now we got an extra $400 a month available. You're going to be contributing $400 a month, which is $4,800 a year into a safe account, right? And this probably isn't going to be a savings account. We're going to shift it up, and we're just going to call it a safe account. And we're going to show you how to deal with that, what your options are for safe accounts as we go through the rest of the course. But right there, you're operating more efficiently. And not only did you free up cash flow, but from a long-term perspective here, what I just showed you is going to save you thousands of dollars of opportunity cost losses and interest expenses that you're just transferring away out of your life, and you're putting it into rebuilding your financial life, right? And the key here is you want to make sure you're in an account that's earning more than 3%. You want to be keeping that money somewhere where you have access, liquidity, use, and control of that money in an account that you have access to, but it's got to be beating inflation over the long period of time, right? You got to be able to beat inflation in the long term. Otherwise, you're just going broke slowly because inflation eats away at your purchasing power of this money. And so that's key to keep in mind. Now, we're going to look at this and, see, maybe it makes sense to keep their money here. Maybe it doesn't. But you could see it really depends. If they had a lot more debt, what I could tell you from a cash flow perspective and what I could tell you is from a financial perspective, it doesn't necessarily make sense in a lot of situations to contribute into your 401k. Once you understand the taxation, what are they doing? They're delaying taxes on this, but they're delaying the tax calculation. And so they're going to pay for Sally, for instance. This is Sally. I keep messing that up. But for Sally, for instance, it's switching both of them every time I change it. That's why. But for Sally, for instance, it doesn't make any sense if she's not getting a contribution. We have to constantly work that out. I'm going to show you in the next module how important it is to save before you invest, but I'm going to leave that conversation for later. All I'm going to tell you for this is that if they had more debt, if they had more toxic debt, that's where it would probably make sense to start taking cash flow out of this $3,600, $2,400, and $1,000, because that adds up to about $7,000 right there. We would reallocate that, pay taxes on it now, probably have $5,000 after taxes, and we would put that $5,000 into an account, or we would put that $5,000, I should say, either into a safe account or towards paying down your debt, and towards paying down this toxic debt. Let's say they had a lot more money on a credit card. Let's say they didn't have access to a CD, right? If they didn't have access to this big chunk of CD, which a lot of people won't have access to that CD, you want to make sure you take, this is going to be the area once you go through and make sure you plug the leaks in your insurances and plug the leaks in your life insurance, auto insurance, home insurance, stuff like that. This is the first place to start, because it doesn't make sense to put money in an account that you're earning 6% on when you're paying super high interest debt on all your other stuff. So that's a big thing. So if you don't have the CD, that's where you want to focus. And now, as we go through that, the next step, if you don't have any of that, let's say you're not contributing to your 401k, you're not contributing enough to your 401k or pension fund or qualified account or anything of that nature in a logical manner, or not logical, but in I guess you don't have the cash flow to contribute to it, or you feel like you're still too strapped, well, a lot of people are still going to have access to capital from their mortgage, right? A lot of people are still going to have access to this. And so let's say this, you got a $220,000 house, a mortgage or principal amount remaining, a $300,000 current market value. You could take out of this mortgage, you could take $20,000 and it's still void PMI, because as long as you have 20% in the house that 20% down, 20% equity into the house, you can refinance and take the cash out. So let's say you could essentially have a $240,000 mortgage on this $300,000 that it's worth. You owe $220. Let's say after closing costs, you get access to $15,000. Well, you could take that. You could pay down all your high interest debt, and I'll be showing you how to do this exactly as we go through. But you could take that, refinance, work with a lender. But here's the cool part. I'm gonna bring up the mortgage amortization calculator, and you can see here that as we go through this, you go from a $240,000 principal and interest. You can see it's $1,216 right here is the monthly payment. But let's say you refinance right now, you take the money out, like, because remember, you financed $240, but because time has worked for you and you've paid down the principal, now you only owe $220, so you have equity available to you. So what I would suggest is to take that $220, refinance the house because you only owe $220 on it for $240, right? Refinance again for $240 to the maximum amount. Right now, let's say you could refinance, you could get it cheaper in the current interest rate environment. It's actually about 3.75 right now, 3.85, but let's just say it's 4% that you could refinance from 4.5%, and we're going to keep it at 30 years. All of a sudden, we went from 1,216 to 1,146. Now, that number on its own, 1,216 minus 1,146 is $66. So we just increased your cash flow monthly just in that by what did I say here? By $66. And so we increased your cash flow just in your mortgage by $66, and we gave you more cash in your pocket. And I'm not saying you want to take that cash and blow it. I would never suggest you take that cash out and pay for vacations or anything like that. But if you have all this toxic high interest debt, if you have $10,000 in credit card debt, if you have this student loan debt, that's something to look at. This auto loan debt, that's something to look at. And then start saving and utilizing the strategies that we're going to teach you in the rest of the course to actually start buying your cars in the most effective way. Because I already showed you how cars work, how you can lose a lot of money just in the way you finance cars. I'm going to show you how to recapture a lot of the expense that you give away to the banks. Yet I'm going to show you how to recapture and make sure that you're the one earning that money. So this is a big focus for people on where you can find this money and move forward and make your life more efficient. And so I hope that makes sense. If you have any questions about this, all I could tell you, fill this form out. You have a fillable PDF download in this module. Fill this sheet out, get it organized, connect with the Life 180 Roadmap financial cash flow consultant. We can help you. You get a free half-hour consultation with one of our cash flow consultants. And what I would suggest is don't take advantage of that until you have this filled out. In fact, if you try to take advantage of that consultation before you fill this out, they're probably going to suggest that you fill this out first. So make sure you go about it in the right order. Now, once you have that straightened out, once you have all your finances organized and you've plugged the leaks or whatever, but even before you plug the leaks, even before you take the step of necessarily doing all that and plugging the leaks, we want to make sure that you come up with an action plan. We want to make sure that you want to have an action plan going. You want to have your own financial action plan where you have all of this really lined up, where you have all you're doing everything intentionally, right? you have a plan where you're starting with the end in mind, and you want to make sure you're thinking about your cash flow, you're thinking about retirement planning, you're thinking about how to reduce your debt in the most effective way, emergency savings fund, long-term savings fund, charitable giving, if you tithe, if you do any of that with your church, any of that stuff you're going to think about. Investing in personal development, like investing in yourself is one of the greatest investments that you can make, and will really drive you to improve in your life. Creating a dream and vision board. I believe in an abundance mindset, and making sure that you're moving forward, and that you're always, not only starting with the end in mind, but you're very intentional. And you gotta, if you don't visualize it, you're never going to achieve it, right? Because if you don't know where you want to go, any road will get you there. And if you don't know where you want to go, it's going to take you a lot longer to kind of chart through the course of life. Now, if you want to start a business, if you want to, anything of this nature, I think it's important to have a survival pack, survival kits. Have your life insurance needs figured out, health insurance, all this stuff. Just go through it. Have will and trust, estate planning. That's obviously, you want to have all this lined up, but it's important to do it all very, very intentionally. So that's the financial action plan. You want to make sure you go through and just put down what you want to do, and revisit this, like what your goal date is for having a written cash flow plan, and then hold yourself accountable. Have your spouse hold you accountable. Work with an advisor, work with a coach that's going to help keep you accountable. That's a lot of the things that our consultants do, is help keep people accountable, but by no means do you need to work with a professional. You can 100% work with your spouse, or if you have a mentor or a business colleague or somebody else that you can go through this process together with, you want to do that. So, and then the next step that you want to go through is you want to figure out your periodic payment planning, because a lot of times people have expenses jump up on them, like jump out at them, and that's what causes people to fall into debt in the first place, right? If you have home repairs and maintenance, if we, budget how much you think home repairs and maintenance are going to cost, and if you think you're going to put $2,000 a year into your house, which is pretty normal, or $2,400 a year, that's a couple $100 a month into their house. I don't think you're going to meet many homeowners that don't put a couple $100 a month into their house, into the either improvement, upkeep, whatever of their house. So do that. Make sure you annualize and save for it. Do it intentionally. If you know you're going to come across, needing to replace a water heater, or if you're going to have a siding issue or a roof issue or a back deck issue or anything like that, just keep putting money aside and do it intentionally, and have that money earmarked for that account, for those expenses. Now, property taxes, a lot of people get, bit when they get hit with a tax bill. Homeowners association fees, you could see all the stuff here. Just really think about what all your expenses are, and think about, if you don't have them coming out of your check on a monthly basis already, like even a lot of people with their auto and life insurance, you can save money on auto and life insurance. Another way to save money is to pay annually. Now, if you can save money by paying the company annually, yet save yourself and pay yourself your own premiums monthly, you just got to get ahead of the curve by a year, and that can actually help increase the financial efficiency of your life. So you need to make sure that you do that, if at all possible. Like, obviously, first things first, you got to get rid of the debt and all that. But once you get to that point, you have to do that. Now, once you do that, that's when you start the debt fountain, right? This is where the debt fountain worksheet, this is where you figure out what's your item, where we list it in order of toxic debt first, meaning highest interest rate debt is the most toxic debt, right? Now, and the other thing to think about here is if you have two loans and each loan is 6.5%, and one of them is deductible and the other isn't, like student loan versus auto loan, if both of them were the same interest rate, well, the auto loan, or whatever the non-deductible interest rate loan is going to be the more toxic interest rate, or more toxic debt, if that makes any sense. So you want to make sure you just go through that. You want to figure out what the total payoff is. You want to figure out what the minimum payments are. And we're going to get into teaching people how to really figure out, to take it to another level, depending on how much debt you have, and especially if you're a business owner, really operating efficiently from a cash flow perspective when it comes to your loan. It's super, super important. So we'll be teaching people how to use cash flow, interest rate indexing, and figuring out, making sure, seeing what impact the loans have on your cash flow in your life. And so go through, work this down, list out all your debts, figure out what the total payments are, what the total debts are, and make sure that you pay those down as fast as possible. And then as you pay off the top debt, that's why we call it the waterfall. As you do it, that money that you save flows over into the next one. That money that you, once you have from there, flows over into the next one. And once you start building the momentum, the bottom ones will get paid off faster. And so it really becomes just miraculous how much momentum you can build once you get going and paying everything down. So I hope that helps. I hope that makes sense. I'm telling you, once you integrate all the information that you've learned in these videos, and you plug your information, and you organize your finances, you use these worksheets and you plug it in, and you get with a Life 180 financial consultant, and you use your free consultation to help coach you through this, you're going to see a world of difference in your life, and you're going to be able to see massive, massive shifts in your ability to regain control of your life. And you're going to have so much better cash flow. You're going to be operating more efficiently, and what you thought seemed like was really, really hard to accomplish, or even just completely daunting and overwhelming, and quite frankly seemed impossible, you're going to start seeing strides. And it's a matter of taking one step in front of the other, little by little. And if you do that over a long enough period of time, you're going to see great changes. In 6 months, a year from now, you're going to be looking back, and you're going to have results, and you're not going to even imagine how you got to where you are at that point in time, especially from where you're starting right now. So I look forward to you continuing with the course. It's going to get a lot more fun. This is where once you get through the debt stuff, that's where we get into creation, right? We got to eliminate the debt before we can create a financial life and financial structure to position you to be able to take advantage of the abundance in this world, and to set yourself up for prosperity and opportunity, and to position yourself to take advantage of everything that this world has to offer, and position yourself like the 1% position themselves, like the most successful people in the world position themselves financially. Because there's a lot of talk in this world going on right now about the great transfer of wealth between the middle class and the 1%, and that the fact that the middle class is disappearing. That is true. But the reality is that the reason that's happening is because the middle class is structuring their financial life a lot like what you're looking at on this sheet right here. And when you do that, you have a lot of inefficiencies, and the middle class is unnecessarily giving money to the big corporations, the banks, the insurance companies, the mortgage companies, and all those type of big corporations. If we can just help them structure their lives like the most successful people in the world do, which is what we're teaching you how to do, great shifts can happen, and you position yourself to take advantage of opportunities that right now probably don't even seem fathomable. So until next time, live abundantly, live efficiently, live Life 180. I'll see you next time.